Ladies and gentlemen, Greg Michalowski here. Today's date is August 13, 2015. Today is my sister's birthday, but I'm not here to talk to you about my sister's birthday. I'm here to talk to you about the death cross. The death cross has been in the news lately on CNBC, on Bloomberg, on your Twitter feed as well. But there are a lot of things that they don't tell you about the death cross. Specifically, they don't tell you about the risk of doing that trade. And that's a big thing in trading because risk is your expenses in your trading business. If a business doesn't pay attention to their expenses or takes too much risk in their business, that's going to be a detriment to their business success or potentially their business success. It may work out, but it may end up that they have large expenses and they never recover from that. And so we as traders have to pay attention to the risk at all times. If we don't pay attention to the risk, whether it's a death cross trade or some other trade, we are not running our business like a business. And so we have to pay attention to that. So I'm going to talk to you about the death cross trade. I'm going to talk to you about the risk of the death cross trade. So let's first define the death cross trade. Well, a death cross trade occurs when the 50-day moving average crosses over the 200-day moving average. Now, it happened in the Dow Industrial Average this week, and it had all sorts of ramifications on the news services, as mentioned, all sorts of commentary about how the market was turning more bearish because the death cross came into effect. Well, let's look at the chart here and look where the price crossed over. Well, when the two moving averages crossed over, where was the price of the Dow Jones? It was around the 17,430 level. And so doing that trade, you would sell a basket of goods or sell the ETF of the Dow Jones at around the 17,430 level and look for your rewards to happen. Well, that says a lot about your rewards, but it doesn't tell you about your risk. Where would your risk be on that trade? And for me, the risk is where the bias turns from more bearish to more bullish. And so looking at this chart, looking at the two moving averages, that would occur if the price were to move back above these two moving averages, right around this level right here. How many Dow points would that be? Well, if you look at it, it comes in around the 17,800 level. So if you sold at 17,430, and your risk is 17,800, you're risking about 370 Dow points. Are you willing to risk 370 Dow points on this death cross trade? Well, if you are, you should have a risk profile or a risk reward profile that would equal at least that 370 Dow point loss if you were to incur it. So you're looking for at least 370 point gain. And if you want to go to 2-to-1, you have to make at least 740 Dow points. I'm not sure that's in the cards, nor that's one of the trades that I would be interested in doing, especially if you look at some of the other broader measures like the S&P index. Is the S&P in a death cross situation? And the answer is no. Is the NASDAQ in a death cross situation? No, not it either. And so this trade carries a lot of risk that potentially could see you're stopped out, and that stop would cost you 370 Dow points. Not the type of risk that I'm willing to take on this trade. Now, would I take the death cross trade at a different time? And the answer is yes, but only under certain circumstances. And what circumstances might they be? Well, if you take a look at the Dow Jones Industrial Average going back to 2007 and 2008, look at the two moving averages there. They cross over too, so we get the death cross pattern right up here. Now, what's also right there? The price. And so the price and the two moving averages come together, and this is Greg Michalowski's death cross. I don't call it the death cross, though. I call it three's a crowd. Three's a crowd occurs where two moving averages and the price converge together. At that point, I'm looking for the price to trend away, either to the upside or to the downside. In this case, with the price moving below those two moving averages, I'm looking for the price to move to the downside. And so if I were to sell right here, where we have the death cross as well occurring, my risk is what? If the price were to move back above those two moving averages. So I'm risking a little, and my reward is potentially more than a little. At the time of the trade, I don't know what the reward is, but as you can see, the death cross situation and the fact that the price was near there, in other words, the three's a crowd situation, created this tension in the market that eventually led to a sharp move to the downside. Not a bad trade. Now, if we look at the broader market at that time as well, the S&P index was also trading right around the death cross area. So we had a same situation where the price started to move below the death cross, giving a sell situation. And so we had confirmation from the broader market that the death cross was more bearish, and that's indeed what the price did, move to the downside. The most important thing is that risk was defined and risk was limited on the trade, and that's the type of death cross trades or threes of crowd trades that I'm interested in. Now, does the crossovers work in foreign exchange? And I got this email from Tyler. Tyler asked me this: do you believe the 100-day moving average crossing over the 200-day moving average in the pound versus US dollar is going to be a significant technical factor here? Well, my answer to Tyler is this: as long as the risk can be defined and limited. In other words, does that threes of crowd situation come into play on the pound versus US dollar chart? And if we take a look at the daily chart here in the pound versus US dollar, you can see that the 100-day moving average, that's the blue line in the chart, is crossing over the 200-day moving average. I prefer those two moving averages in foreign exchange compared to the 50 and 200 in the equity market. So we do get a bullish crossover here by having the 100 cross over the 200. But look where the price is. The price is about 220 pips away from those two moving averages. That would be the risk on my trade on this chart. So my answer to Tyler is no. This crossover of the 100 and 200-day moving average has no significance to me. After all, the price could actually go all the way down to the 100 and 200-day moving average and still be bullish from a technical perspective. It's only when the price moves below those two moving averages that it turns bearish. So there's a 220 pip leeway there, or slippage area, where you can lose that amount on the trade, and I have no interest in doing that trade. Now, could I look at a shorter term chart and see same threes of crowd situation and trade off of that? And the answer is yes. So let's go to the hourly chart of the pound versus US dollar. And what do we notice here? Our two moving averages are converging together, creating that potential for that crossover situation. What else do we see here? The price moving down to test those two moving averages. Now, we don't get to the point where we have the crossover at the low point where the price is trading at, but that price gets within 10 pips of the lower 100-hour moving average, that blue line in the chart. And so my question to you is, as a trader who's focused on risk, are you willing to risk 10 to 15 pips in order to have a potential reward from the market moving higher from that level? And the answer to me is yes, all the time. As long as the price remains above those two moving averages, the bias is bullish. If the price were to move below those two moving averages, all the bets are off. I'm out of the trade. If we get that crossover of those two moving averages at the same time that the price is testing those moving averages, like it's sort of doing right here, that's the best case situation, because my risk can be defined, my risk is limited, and I have the potential to make more than I risk. In this example, it doesn't look like the price moved that far away from that risk defining level. But in fact, it's 2 or 3 times greater than the risk that I took on the trade. I only had to risk about 10 to 15 pips, and the reward is about 40 or 45 pips. And it's only just beginning. So the point is, my friends, is that the death cross that they talk about on the news is just one side of the story. They don't talk to you about the risk side, often the case in our media. But you as a smart trader are going to pay attention to the risk. You're going to ask the question, what is the risk on that death cross trade? And you're going to find that if we're not in a threes of crowd situation, that is when the two moving averages and the price converge, you're not going to be all that interested in that crossover pattern. It's just a crossover pattern. My name is Michalowski. Good fortune with your trading.